What's up, y'all? This is Winston Bennett. Hope you're having a fabulous day today. It is August the 18th, 2023. So the days are flying by, and I don't want to waste any time here. I want to get right into it. Hey, our video today is going to be on renting versus buying, and we're talking about a home here. Either renting an apartment or renting a home versus buying a home. What are the pluses and minuses of each? In the economic environment that we are now here in 2023, as you know, interest rates are higher than what they've ever been. I mean, they've been higher, but it's a high interest rate environment where over the last 10 years or so, we've been in a very low interest rate environment, as low as 2%. You know, the medium interest rate today, conventional, might be around 7.25 or so. And let me preface what I'm saying here on any of this that I'm saying. It's just going to be a brief overview. And please, reach out to your mortgage professional, your real estate professional. These are guys that are in the industry every day. But this will just give you some questions to ask them and give you just a little bit of information as you seek to either, lease an apartment or buy a home. Let's start on the leasing side. On leasing an apartment, you just have a minimal amount of things that you have to be concerned with. Number one is, how much is the apartment going to be leased for? Okay. If you're buying a one-bedroom apartment or leasing a one-bedroom apartment, possibly your rent's going to be $1,000 a month. Possibly on top of your rent, you got utilities. Let's just say it's going to be another $200 a month. And I'm just throwing out numbers. So now you're up to $1,200. What else do I have to consider? Maybe garbage disposal, maybe cable is thrown in there. So, let's just say $1,300 a month for your rent. And that's about all you got to consider when it comes to an apartment. So let's flip over and let's go on the housing side. If you're going to purchase a house, let's say $100,000 house, one of the things you have to consider is how much money do you have to put down? And even before you get to that, the first thing the bank is going to look at is how much income you have coming in from your job, because they look at income. They don't look at your inheritance. They don't look at what you've got in your 401k. They'll consider those things, but the main thing they're going to look at is what's your monthly income coming in. They're going to base whether they're going to give you a loan off of, one, your credit score. Do you have a high enough credit score? That means 620 and above. And sometimes they'll go as low as 580 for a veteran. Again, check with your mortgage professional on this, because rules change, every day. Okay, so they're going to check your credit score to make sure you got good credit. What does credit tell them? Credit tells them if you're paying your bills on time. Can they rely upon you to pay your bills, your monthly bills, in a timely fashion? That credit report is going to show them if you've got any delinquencies on your credit report. To have delinquencies on that credit report is a negative for the person that's giving you the money, the bank, let's say, that's going to make a loan to you. Okay, so what are they going to look at? They're going to look at your income that you have coming in from your job, your monthly gross income, not your net. They're going to look at your gross. You would think they look at the net, which you're bringing home, but they actually base it off your net income. Based off your net income, you've got to be able to supply that household. Not only your house, but what about your food, your gas, all the other things that you have that's got to go into that. Now you're going to tack in a house note on top of that. So they're going to look at what's called your debt ratios. What is your debt ratio? The income you have coming in versus the outgo, or the debt that you have on that income coming in. So they're going to look at that. They're going to look at what's called loan to value ratio. The value of the home versus the loan that the bank will make to you. It's called the loan to value ratio. And they're going to want that to be a certain percentage. Okay. So let's move forward. Let's just say that the bank decided that your credit score was good. Your debt to equity ratio is good. Loan to value looks good. And we're going to make you the loan. Now, if they make you the loan, now all of a sudden you're going to have some responsibilities again on your end that you're going to have to take care of. Number one, depending on what type of loan that you get, whether it's an FHA loan, which is Federal Housing Allowance, or something of that nature, Federal Housing Association, or whether it's going to be a conventional loan. What's the difference between the two? Well, there's certain perks that you get with a conventional loan. In order to get a conventional loan, you got to have a good credit score. Now, good credit score, it changes. So, it could be a credit score in the 700s, 720 and above, let's say. All right. An FHA loan, they will allow you to get a loan with a lower credit score. Again, maybe as low as 620 and maybe even a little lower than that. So what that FHA is for was put in place for people who didn't quite have the higher credit score and wanted to give those people an opportunity to still purchase a home without alleviating them or keeping them out of the home purchase market, okay? So they're going to look at your credit. Do you have good credit? Do you have the ability to pay your loans on time? Are you paying your gas bill, your water bill, your credit cards all on time? Let me speak about credit cards just briefly. One of the things that will help you have a more positive credit score is to keep your credit cards below 30% of their value. A lot of people don't know that. Once you exceed 30% of the value of that credit card, then you will get a negative credit score, okay? Points will be deducted instead of having a plus, on that credit score. So keep those credit cards below 30% of their value, then you'll see that your credit score is going to be more positive, okay? All right, good. All right, so we talked about, let's talk about down payment. On an FHA loan, you can go as low as 3.5% on a down payment on a home, okay? So $100,000 home times that by 3.5%, whatever that comes out to, that's going to be your down payment on the home, okay? On a conventional loan, they usually like to see you put down 20%. So on a $100,000 home, what are you looking at? $20,000 down. Okay, and you don't have to put 20,000 down. Anywhere in between that 3.5 and that 20% down is something that you can pay. But again, it's going to depend on which loan you have, conventional or FHA. Now, suffice it to say, there's another loan out there called VA, and that's for our veterans. Where they can go as low as 580 credit score. Okay, so that's a whole different animal there because they get some allowances that a lot of us don't get. So we're talking about leasing an apartment or home versus buying a home. You can see from leasing a home, you don't have to worry about too many things. Certainly, they're going to look at your credit score on leasing a home or apartment as well. But you basically got whatever your monthly expense on the apartment's going to be, and then you got your utilities that you're looking at. Okay, but then when you go on the other side of the ledger and you look at buying a home, you got to make sure you got a great credit score. They're going to look and see what your income is and basing it off your monthly income. What is your monthly gross income? How much do you have coming in? And then they're going to look at your bills that are coming out of that monthly income and add it into whatever your monthly payment's going to be on the house. Now, that monthly payment includes not only principal and interest, that's called P&I, principal and interest, okay? You got to pay that. So, for instance, I'm going to throw out a number. On a $200,000 home, maybe your principal and interest is $1,252. Let's just say principal and interest only. That does not include T&I, taxes and insurance. Now, you throw in taxes and insurance, they are going to approximate what taxes and insurance are going to be. Your taxes and insurance could be, another, who knows how much that's going to be. That could be another $500, $600, $700 a month added into your payment, bringing that payment to about, $1,800, $900 a month. You see where I'm going with this? A lot more is required on buying a home versus leasing an apartment. But our society teaches us that it's better to buy if you can afford than to lease. When you lease, one of the things that the financial pundits say that you're just throwing your money in a hole, never to be seen again. Whereas you buy, there's benefits to buying a home. One, you can write off some of the interest still. Some of those benefits are going away. The other thing is once the home appreciates or goes up in value, you can go back after a couple of years and maybe refinance that home if your interest rates are lower. Refinance, meaning trying to get a lower monthly payment. And then also you can pull out, you can pull out up to 80% of the value of the home on a conventional loan. So we'll get into that on the next video. I don't want to make this too long because I'm throwing a lot of information at you pretty quickly. So look at what we've talked about here on purchasing a home, down payment. How much down payment am I going to have to put down? That depends on which loan you get. If it's an FHA loan, you can go as low as 3.5%. If it's a conventional loan, they may want you to put down 20%. But a conventional loan is seen as having a few more perks than the FHA. The FHA allows you to have a lower credit score and still get in on the purchase of a home. Here's another thing I want to make you aware of too. Anytime that you put down less than 20% on a home, a mortgage company will also add in what's called mortgage insurance. Now, what is mortgage insurance? Mortgage insurance is insurance for the lender or for that bank, just in case you default on that loan. That mortgage insurance will come in and make up the difference, so the bank itself is not on the hook, for you not paying the loan. If you default or if it has to be foreclosed upon, that mortgage insurance will kick in for the lender. Now, remember, the person who's getting you the loan is the one that's looking for all these allowances and making sure that every I is dotted, every T is crossed, because if they're going to give you money, they want their money back plus interest. Okay, so that's what the bank is looking for, their money back plus interest. Okay. All right. Good. All right. So we've talked about what? Down payment. We talked about the fact that a bank is going to look at your income that you're making from your job, your monthly income. Yeah, it'll look at your overall what you make a year, but they're going to break that down into a monthly. Out of that monthly income, they want to know what expenses is coming out of that monthly income. Your gas, your food, your light, anything that you're paying now, what's coming out. And then once they throw in this mortgage, this principal and interest on a new home, what's that going to bring your debt to equity ratio? What is that going to bring that to? You understand what I'm saying? All right. So on a home, you pay principal and interest. That's called principal P, interest I. So that's called PI. You also pay taxes T, insurance I. So PITI. You'll hear those acronyms or those letters pronounced. So you'll know already it's principal, interest, taxes, and insurance. And all four of them can be in one monthly payment. Some people put that in one monthly payment. Other people will pay their principal and interest, and then they'll pay their taxes and insurance separately. I prefer to have it all in one, so we don't have to think about, okay, when is taxes due? When is insurance due? It's all in my one payment. So that's one less thing I have to worry about. All right. So we covered a lot of ground there. So again, we talked about what's the difference between leasing an apartment. A lot less to worry about if you lease an apartment, but you have no ownership rights. Okay. You can't write off your monthly rent versus a home where you can write off. You got some write-offs there still remaining. You can write off some of your interest. But again, check with your tax people. Check with your real estate professional. Check with your mortgage people. Okay, I'm just giving you a high over level or low over level view for someone that's been through this a few times and can talk to you a little bit about it. Okay, let's see what else we need to cover here. There's a lot of expenses that goes into owning a home. One of the things a bank will do if they make you a loan is they'll have an appraisal done on the home. Now, what's an appraisal? That's where they're looking for the value of the home. So they'll send an appraiser out there to assess the value of the home. So if you go out there and you see $100,000 home, well, the bank wants to make sure that that thing is indeed $100,000. It's worth that. Some people may inflate the house, inflate the price on the home. Well, the bank's going to make sure it is what it is. Okay, before it gives you a loan. It's not going to make a faulty loan on something that is not holding up to value. It must hold value. Okay, that's called an appraisal. The other thing, of course, you're going to want to do is have inspections done on the house. If you purchase a home, you want to make sure that home doesn't have termites. It don't have mice. You know what I'm saying? You may want to have a radon inspection done to make sure there's no radon in the home. So there's a lot of things that you got to, look to when you purchase a home versus renting an apartment. So you have to be make sure that you're ready for it. Okay. All right. We'll talk later. Thank you.